The views and opinions of this program are those of the host, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Today's episode of Market Talk is brought to you by Growmark FS. Keeping up with the latest in ag is a challenge, to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic, grain, and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. Well, overall, throughout the grain and livestock trade on the day on Wednesday, I'll call it a fairly quiet market. A few things of note. We did see some intermarket spreading in corn and soybeans. The wheat trade backed off the highs a bit. Cattle remained strong. We had plenty of things to digest, though, in the markets. On top of the WASDE report from yesterday, we had more economic data out on Wednesday. Joining us to discuss, Mike Zuzolo, Global Commodity Analytics. Mike, great to catch up with you again this week, sir. I hope things are going well.
You too, Jesse. Glad to be back with you, sir.
I appreciate the time as always. I want to jump right in. As I mentioned, kind of a quiet-ish market on the day. It felt like Wednesday with a few nuggets in there. I know we're going to dissect a little bit. But top of mind, I know we got that headline inflation data out Wednesday morning with the consumer price index. So talk to us about that and some of the impact you saw there. And I'll pull up on the video feed a chart that you want to look at as well that kind of ties in with all of this. So what's your take on what we saw from Wednesday?
Yeah, post-report day was a nice day because we didn't give way technically, and we kind of rebuilt the bridge, so to speak, when we tested the support in the soybeans and we're able to come back up. And I think we're at a point now, Jesse, where the report for the grains, unless we really turn on the planters and get the calendar moving on the planting pace, I think the grain report, wheat, corn, underpins us and puts a floor underneath us. Soybeans I was worried about on the report, but I also kept watching that Brazilian currency. And when I came in yesterday, we were up in the beans. Why would that be other than just pre-report jitters? Well, it was because the currency in Brazilian real was heading down towards its major lows. Today we took that major high against the dollar. Today we took that major high out, and we're now at the strongest in the Brazilian currency versus the US dollar since June of last year. Why did I answer your question about the CPI data like that? Because that CPI data, along with the World Economic Forum update with the World Economic Outlook, and also the Department of Energy short-term energy outlook update giving us crude oil forecast prices, all that kind of revolves around that macro market, the strength in the crude oil surpassing $83 a barrel, thanks to the decline in the dollar. That decline in the dollar, I think, primarily due to the CPI coming in a little weaker than the traders thought, and it kind of added to the flavor of the mindset. And I think it's a strengthening mindset in the bond market and the futures between both the equities and the commodities that the Federal Reserve is going to have to back off their interest rate hikes. Now, how do we translate that into our talk and our world that you and I deal with? Well, this is one of the charts I use. This is the S&P 500 futures, which is the equity index, and against the S&P Goldman Sachs commodity index, the broad-based commodity index. And we notice ever since essentially the end of February, 1st of March, we've seen a real turn in the relationship between these two assets from a relatively negative position mindset of negative 0.3 roughly, now up to a positive 0.65. So you've had a 100-point shift essentially in this relationship on a 10-week basis. They're both getting stronger and stronger in terms of positive mindset. In fact, that plus 0.64 you see on this chart is the highest level since essentially October, November of last year. This tells me that, yes, these big reports that came out, other than the WASDE report, are having some play in our price action because of the crude oil and the dollar play. And most importantly, we've really got to watch the S&P and the bonds again, because they're going to play a major role with the dollar and the crude oil, which will probably come back around through the wheat and corn and beans and even livestock if the trade doesn't get what they want from the Federal Reserve. So we're on Fed watch because this correlation chart's so positive.
Well, not only are we on Fed watch, I'd say we're on weather watch here as well, Mike. And I want to talk about that just a little bit because this trade action, now that we've gotten into April, we're hearing more about planters rolling. Starting to see not only the trade focus on some of the supply and demand fundamentals and some of these macros, but really start to focus in on weather here as we move forward the next couple of weeks. What's your take on just kind of that shift in tone in the markets right now?
Yeah, I created this map from USDA after the crop conditions showed Kansas very poor ratings at 61% this week. And we have to realize, Jesse, the all wheat yield back in years where we had bad Kansas crops like 2013, 2014, where our very poor to poor was around 30, 33%, essentially half of what it is now. Our all wheat yield could not get above 42 and a half bushels. And so the trade still hasn't come to the reckoning that this overlay map, which shows with the greens, it colors the highest level countywide of production in wheat, overlaying with the crop moisture levels, which would be the browns and the bright reds and the yellows. And you can see with that overlay that in the very highest productive land, we have the very worst of the crop conditions. And so I would go out on a limb at this point and say, after this week's crop conditions being double as bad as they were back in 10 years ago, it's going to be extremely hard, in my opinion, to get the all wheat yield above 40 bushels. USDA is carrying 47, 48, even almost a 49 bushel yield, typically with the trend line yield. So that's where the rubber hits the road. And I have confirmed this map through talking to clients and subscribers throughout the areas that this map shows up. And, Wichita, Kansas, a very good client, Sedgwick County, more towards the south central, southwestern part of the state where it's not quite as bad. He's talking about wheat turning blue and he's losing it. You go west of him and pretty much directly west of him, and you get into counties south of Scott County, in say Leota. You're talking about several clients told me today, crop insurance adjusters are zeroing out as much as a third of their fields. And it could be higher than that a week from today. And so this map really shows me that A, wheat is the leader. B, the trade still is too focused on the European markets and the Baltic markets, and they're not really looking at what our all wheat yield number could be here in a couple, 3 months.
And I'll throw another piece at you on that, Mike. Just thinking of the northern plains, the snowpack that we have up there, and we got to get things melted. We're going to deal with flooding issues. That spring wheat number, what happens if we don't get spring wheat planted? How does that add into the all wheat number? And also, how does that affect the corn and soybean markets as well moving forward? I think that's a question mark for us right now, Mike.
It without a doubt is. I think that's an excellent point. And I think this is where the commodity markets, the wheat market in particular, is still being traded more as an asset than it is a commodity, because after the crop report showing only 1% planted, yes, it's early, but it doesn't look like we're going to get much done the next 2 or 3 weeks. And the models continue to get wetter, and they continue in those northern states, those northern tier states, to be relatively cold and below normal temperatures for the next week. And so the trades, I think, just falling behind on the supply side because all they can think about is the demand side and what's going on geopolitically. So I say it all the time, but I really think wheat is the best commodity canary in the coal mine for if we're looking for a major trend shift to the upside and essentially a demand and fund-led rally to the upside.
And it felt like on Wednesday's trade that wheat, I know we backed off the highs a bit, but I wonder if that was maybe just a little bit of profit taking late in the session with a lack of any other news headlines to trade on Wednesday, Mike, especially Kansas City wheat.
Yeah, I think that's an excellent point because spring and Kansas City have been the leaders to the downside. And I'll throw one other thing out at you too after the report and what we saw in the world ending stocks for soybeans going above 100 million metric tons. I think we're back to a place with $15 May beans. If we're going to go higher on the Brazilian currency being so strong, I think the beans are going to need at least the meal and probably also need the wheat and the corn to help support it.
One other note here, I want to talk a little bit more on this soy complex. I know we have a few more charts there. Just Wednesday's action, both corn and beans, it looked like some intermarket spreads there. I have to think maybe that end users trying to pull corn and beans out of farmers' hands here, Mike?
Yeah, exactly. I think the bull spread working really, really well is a nice feature, and it really does suggest that the grain stocks report and those ending stocks here domestically of 1.3 on the corn and 210 on the beans, we are super tight, and it's going to be really tough if we have any kind of planting delays anywhere in the country to get anything from the farmers. And we have to remember the grain stocks report, by and large, showed that most of the farmer held stocks are east of the Mississippi River.
We are having a conversation today with Mike Zuzolo of Global Commodity Analytics. Mike, let's talk a little bit more on the soy complex. You have a few more charts for us. I'll pull up the monthly soy continuation chart. Really, this entire soy complex, everything surrounding the South America crop that cuts to the Argentine production again. Obviously, just watching our market here, the whole thing, the soy complex just fascinates me here as of late, Mike. So, educate me a little bit. What's kind of the latest you're seeing here post report? Let's dive into this a little bit more.
Yeah, this monthly chart, I'm a big fan of wedges, especially in a market like we've had in the last year and a half, 2 years, because the sentiment and the coiling of the nervousness and the smaller and smaller ranges tend to breed more of a break to the one side or the other in a very strong way. And that's why this chart shows two wedges, one that, came to a point in mid to late 2021. It broke hard. It went down to a major trend line support drawn off the 2020 lows. It held, and then we had the blast off from the essentially late 21 all the way to mid 2022. Well, now we've redeveloped another wedge. It's even bigger because it is drawn off that 2021 and 2020 low. And now we're looking at coming to right at the point. So after yesterday's report and 100 million metric tons of ending stocks and a Brazilian crop that just keeps on coming, I got to wonder, why wouldn't we break to the downside on this July and this May bean chart? May for right now, but getting ready to go into delivery here at the end of the month. Why wouldn't we break to the downside? And again, I would stress, Jesse, probably because the meal and the currencies, and probably because the wheat and the corn catch. And so it's really setting us up this month for a major break next month, one way or the other.
Well, and thinking as well, throw in world soy prices here as well. Well, another chart on the video feed, but looking at the Paranagua price, Argentina's price, the Gulf price, there's a lot that's kind of going into this whole picture that you're laying out for us right now, Mike.
Yeah, there really is. And this chart is really important from a standpoint of what USDA did to South American supplies yesterday. They took the Brazilian crop up 1 million, Argentina down 6. But you know what? They didn't change the Argentine exports one bit. It's still sitting at a plus 3.4 million tons. So how can Argentina ship out 3.4 million tons of soybeans when the USDA took their crush down 2.5 million? So there's a lot of questions, probably more questions than I can remember when it comes to the Argentine soy situation now than opposed to 4 months ago when we didn't even know the crop size. So that takes me back to this chart right here, Jesse. If we're going to have a fundamental reason to rally, it's not going to come from Brazil. I think it's going to come from Argentina. And that's where we see the Argentine bean price at $572 a ton. We see our price at almost $600 a ton. And that's the Gulf of Mexico price. If you take the Pacific Northwest, which we're having terrible West Coast shipping issues again because of labor issues, but if you take Portland's price in Oregon right now, it's at $610 a ton. So you look at Brazil and orange, we're literally about $100 a ton more expensive to get our beans out to the export market than Brazil is right now. So we really have to look to Argentina if we're going to change the dynamic of the Brazilians continuing to take our business. And I don't see that happening right now, but I'm talking about currencies and meal and this Argentine bean prices, the three leading indicators to why we wouldn't break lower in the beans. So as you can see by this chart, I'm very defensive on the soybeans without the wheat and the corn.
Well, Mike, before we move to livestock, I know we've covered quite a bit here in the grains. Any other thoughts on your mind in this grain trade just before we shift gears here?
The only thing I would say is the corn stocks to use ratio globally, Jesse, since we haven't talked too much about the corn other than the spread, we're back to 25.5%. That's a 3-year low in the world corn stocks to use ratios. So we are very tight as well, both domestically and globally. So I think corn is very ready for a rally. The cash is kind of signaling that. The spreads are signaling that. We're just waiting on the wheat.
Let's talk livestock. This cattle market, Mike, just continues to be on fire here, buddy. Man, oh man. Um, we've been talking about it. We've been waiting for it, and just feels like we're continuing to churn this thing higher. What's your thoughts? What's the latest you're seeing throughout this cattle trade right now, Mike?
Yeah, there's no slowdown in the feeder cattle with the cash market. I was watching some online auctions this morning, and they're still very active buying and very serious buying. Mid six weights going for 210, mid seven weights going for just under 200, 197. So you can see that the cash market in the feeder complex is still red hot. People don't seem to be too worried. This was one of Nebraska's auctions. People don't seem to be too worried yet about the drought, and that's kind of concerns me. But getting to this chart, I think what we're looking at right now with this move in the fat cattle above the 2014 highs now, we're looking for a weekly close lower and then a monthly close lower to signal the top of a cycle. So today's price action, you want to butt up against the weekly low in the April futures of 170.90. If you take that out, you're right back to that purple trend line, and you're opening yourself up to the monthly low this month of 167.95. If you go back below 167.50-ish, you're taking out the last 3 months of highs, and you're getting back below into new monthly lows. And that would, I think, signal a sell signal that could last for a month or two. Now, why am I bringing this sell signal up in the midst of such a great bull run? Well, it's because USDA showed us yesterday with two different reports that beef production is going to be down 5% here, but our exports are going to be down 11%. We're going to cut our export demand legs out from underneath us with these kind of prices. Secondly, USDA gave us a top in the Q2 price for the year for steers at 169. So we're already building in a $5 premium to that. The higher we go above that, the more downside we have later on, because USDA is giving us a Q3 price of 162.
Well, and you mentioned, cutting the export demand legs out from underneath us, and I can't imagine we would make that up with retail demand, because the supply of beef being smaller and folks maybe going to cheaper cuts. I can't imagine we'd make anything up there, Mike.
No, you're right. I think it's a tale of two cities with the domestic retail market. Just some new stuff coming out. The grocery store retailing really weak, down 8-9%, 2 weeks in a row right now for beef. But the restaurants, January, February combined, up almost 16-17% versus February of 2022. So people are still going out and eating out. The question is, are they picking the beef, or are they picking some other type of protein? But it is definitely showing signs of weakness and signs of wear at these price levels. So that's where the currencies come into play and the equities come into play. The summer gas season, the summer driving season really comes into play. We're on really thin ice, keeping our consumption high when it comes to the beef side.
Hogs continue to struggle. Anything good to say in this hog market, Mike? I'm at a loss at this point.
I think that China is back in the market. I would not be surprised to see them back in again on Thursday's weekly export sales. And the USDA is showing the retail numbers coming back up and the featuring for the pork. So I still think that $80 cutout values is a really solid point here. And I still am looking for that elusive seasonal low. So maybe we'll get it by the end of this month.
Mike, great stuff as always. Any final thoughts for us here today?
That should do it, Jesse. Thanks for having me.
Well, and I know folks, if they want to check out your analysis, they could do that very easily on your website, can't they, Mike?
Yes, they can. I'm getting ready to issue a brand new trader newsletter that's going to be a weekly newsletter, more for the traders, less for the hedgers, by demand from some of the people I work with. They want to look at some trading recommendations. So go to globalcomresearch.com and sign up for a trial and request that trader newsletter if you're interested.
Mike Zuzolo, Global Commodity Analytics. Always a pleasure, sir. Thanks so much. Have a great week.
Thanks, Jesse. You too.
Let's go do it for Market Talk today. Find us online, markettalkag.com. I'm Jesse Allen. Have a great afternoon.